All right. Good morning, everybody. Hopefully you enjoyed your 3-day weekend. We've been waiting forever to get this break. We may just finally be getting it and start out where we normally do and circle back though. All right. CPI for Canada today. It's kind of the biggest thing that we have this morning. And then beyond that at 9:45, we have some manufacturing data, which is going to be a big deal. Then we have the auctions today, 11:30 and 1 o'clock. This does have the 2-year, so it's kind of important. And then we're going to have some European central bankers chipping teeth, including Christine Lagarde. So it says speech, but I mean, that's pretty late in the evening for Europe. So I don't know. I'm curious about what this one is. You know, a lot of times if it's just some BS luncheon or something like that, then they're not going to make any significant statements. Or, you know, if it's pre-recorded, then, you know, obviously there's not going to be any Q&A. So yeah, just because it shows somebody's going to be talking doesn't always mean that, you know, some violence is coming in. But either way, that's 2 o'clock. So kind of keep your eye on it. And it would also be the wrap for the day, right? It's going to kind of finish it up. We are down this morning, but I want to stress that we're only mildly down this morning. And it's not like crazy negative out there. This right here kind of explains a little bit about the down move that we're seeing. It's not the only thing, right? But they're having to kind of kick the can down the road a little bit and price in farther down on the curve. So this has a little bit to do with what we're seeing going on. 75 basis point increase by Federal Reserve by July. Pricing that in is a part of the weakness that we've been seeing, and kind of goes right back to my point about us being down this morning, but not necessarily bearish this morning. 4 months ago, 6 months ago, 8 months ago, if we'd have said something like, oh, we're going to add in another 75 basis points for July, and July might seem like a long ways out, but it's really not that far. We'd have seen this market turn tail and dump pretty solid to the downside. And instead, we're mildly weak. Really? That's all we got? It still shows how much under the hood buying pressure there is. So, you know, yes, we're down this morning, but take that with a grain of salt. Get salty with it then, huh? All right. So again, that's Canadian CPI, US retail sales, composite flash. All of these, every single one of them this morning have weight or impact potential. So make no mistake about it. It's going to be a wild morning. Now, if we come in line on every one of these numbers and nothing, you know, operation don't rock the boat, then we're just going to have to deal with this basis point curve being priced in. But any one of these get out of line with a surprise or a shock number, and it will grab the narrative, and that'll be the thing for the day. And even though it seems like I'm the only one that ever talks about these auctions, pay particular attention to the clock at 11:30 and 1 o'clock today. 11, 11:30, and 1 o'clock. Those auctions are very often a sneaky little game changer, that shifts the entire dynamic of the marketplace. And since they're rarely reported on, other than Finance Juice putting in a little blip that says, how many participants there were or what price the auction concluded at, that's really all that is covered. That white line that I just drew is a linear regression line. It is calculated automatically. You can find it right there, regression line. I started it on this lowest point and I ended it where we are. Kind of pay attention to the swings, right? It's what the market does. Now, it doesn't owe a move all the way down here. Just like when we rounded from down here, we didn't immediately come all the way up, right? We got stuck here in the middle. So we came up, hit resistance and came back down, and then we completed the move. So just because we're rolling over right now does not mean that we're going to come all the way down and complete this curve, right? This sine wave curve. We could get shunted or blocked or in some way find some support here and come right back up first, just like it did, came down again in like a little bit of a Busby move. So again, weakness. Another thing that's going to be tricky for today, and it's something that everybody has to kind of come to terms with on their own, is the way that brokers deal with holiday. It sucks. There is no good way to do this. So one of the things that you could consider is you take yesterday's trading and you wrap it up into today's price action, and you look at everything from Friday's close until now as one trading event. All right, so you wouldn't look at yesterday with the open high low close on the RTH. You wouldn't focus on Globex bottom, nothing like that. Right, just treat all of it as one single candle, one unit. It's not perfect, but I think if you do that, you'll find more insight and value and opportunity. Volume, it's within lines, 140s, 150s. There's absolutely nothing wrong with that for 7:30 in the morning. It shows participation without aggressive participation, right? We're not getting into like the 200s or something like that. Can't tell you the last time I've seen some 220s, 250s by 7:30 in the morning. And we're not below 100 this morning. So they're not sitting out waiting on Canadian CPI. We don't have a market maker move this morning, and our 21-day ADR is 1.6. Half the ADR is 41.15. The full ADR is 41.48. To the downside, it's 40.50, which we've made contact with already. And the other one would be 40.17. Now, if you're looking at those two numbers, 41.48 and 40.17, and you're thinking, come on, Sig, man, that's a long ways. You're kind of reaching here. That's the average daily move, right? I'm not pulling these numbers out of my hat. Math, right? I love math. This is the average move that we've been making. So we could easily move this distance, and it wouldn't even be considered a big move at that point. That'd just be the normal move. So if things do get out of control today, anticipate a move much farther than that. My baseline bet, if things get out of control, is 2%. Oddly enough, the way the S&P moves, round percentages tends to take control more often than not. So it'd be 1, 1.5, 2, 2.5, 3, 3.5, like that, instead of 1.68, right? So if we get above 1.5%, we're more likely to go to 2% than we are to go to just 1.6. 10-day, 30-minute volume profile. Nearly a classic D shape. We're almost there. We're at the bottom of the box, and we're at the bottom. We expect to go to the top. When we're at the top, we expect to go to the bottom. To make that trip, we would have to get through the point of control, which is 41.31, which it seems like it's been that way for a while now. And we've gone through it multiple times, so it has no respect out of that line or value or weight. The market's just going to run right through it like it just doesn't care. We're starting to form a B shape on the TPO. It's worth kind of keeping our eye on that. And we did expand to the downside in this volume profile. So it does look like we're going to be opening up some lower numbers. Just keep in mind what I said at the beginning, that we can't get overly bearish yet. There's still a lot of signals that say, you know, there's a lot of weakness. There's actually conflicting signals on a lot of things that we're looking at. And so you should proceed with caution. We had a VPOC from Friday, but it got taken out. We're already done with it. So we still have 4,100, well, 4,107 and 39.88. Now, with all of this time having gone by, how far away from the 10 we are becomes more relevant, right? It's like, how fast have we moved? And did we move too far, too fast? This says, no, we have not moved too far, too fast. We're nearly 0.75% underneath the 10-day moving average, which is nothing. We can, on average, go 3% below the 10-day moving average before we would even consider the idea that we're oversold. And I don't like that phrase, oversold, but I mean, we got to use something, right? Use your words. On the 10-week, however, man, let's adjust this back to the ES. We'll go back and look at the day here in a minute. On the 10-week, we're still above it. More than 0.5%, but we are on the decline, and that's the way this thing generally goes, right? We fall away from the 10, and then we work our way back up to the 10, and then we fall below the 10, right? It's just the same old thing, sine wave, same thing we were looking at a little bit ago, just looking at it differently. So we are coming back to the 10, and this is where I wanted to stress my note of caution. Yeah, we're weak. Yeah, we're down on the day, but just a little bit down. And we're coming down into that 10-week, which is a serious level of support. Now, I don't look at moving averages and, kind of say they're support and resistance sort of things, right? I mean, we got to use a word, so we'll call it support, but don't trust this thing. It's not a handrail to lean on. So I'll use the word support, but I don't like it. when it comes to moving average strategies and how price responds around that 10, it very often becomes the turning point, whether we call it support or, supply and demand zones, use whatever you want. Price very often deflects or turns or reverses or pivots or in some way responds to the 10. If we're coming down into that 10 and just make contact with it for a nice little bounce, this weakness will flip right back around, and all of that bullish strength that's underneath the market is going to come right back in again. It's not gone. It hasn't left. So don't get all bared up thinking we're headed down to, 3,500s kind of thing. We're still above the 10. And since I was on the SPX when we were looking at days instead of the ES, let's jump back over there real quick and look at the ES. More than 1% below the 10-day, which is fine. I mean, again, we can go, 3% below the 10 before we consider being, even remotely oversold. That's a good question. It's the one question I get all the time whenever I talk about a moving average. EMA or SMA? Now, I made this indicator down here, and I built it using EMA. Thinkorswim already had a tool very similar to this, and I hijacked some of their code to make mine, and theirs was already looking at the EMA. So maybe it doesn't matter, but they were already using it, so I used it too. And the thing about moving averages, a lot of books will say if you're going to use low numbers, to use the EMA since it's so responsive, right? And it weighs the front end. So it absolutely takes into account whatever you're dealing with today. And that if you're dealing in a lower time frame chart, that the EMA also is a good fit for low moving average numbers. Because in those lower charts, we're not looking for a dominant trend, right? And that's where simple moving averages really come into play. So for the legacy, old school, dominant, big picture, longer time frame charts, the simple moving average is the way to go. If you're dealing with short duration charts, and especially low numbered moving averages, the EMA is the good way to go. Now, the way that I personally approach this is if it's above or at 50, I use both. I have both the 50 EMA and the SMA, the 200 EMA and the SMA. And if it's below 50, then I just use the EMA. And I wish it was better, right? I wish there was a better definitive answer to that, because it really is one of the premier questions asked everywhere when it comes to moving averages. Which is why I eventually started using both on the higher time frame, like the 50, the 100, the 200, the 400. And I thought it was silly to use 400 and 600 until I was reading some hedge fund books, and they like those numbers, which is just kind of weird. But hey, whatever, right? If that's what they're looking at, I want to see what they see. I want to look at what they're looking at. All right, maybe a little sloppy, but we are just barely outside of this box. Not enough to turn us bearish, especially if you think about IBD and what IBD really kind of promotes for a good double bottom, right? If you have a bottom and price is coming back down and you're thinking, oh yeah, double bottom, you want it to go lower than the previous low. That is why a double bottom is so good. It's a trap. And then it squeezes everybody and you get that nice explosive follow through. And that's why it's such a good trade, because the trade happens so fast. It follows through really quick. So when you get the double bottom like we have right here, and we've gone lower than the previous low, you can't just take it because it's a breakout. It's a double bottom. We failed to hold like we held here. So we should short it. You could, but if it's a trap, it's just going to be squeezing you like it squeezed everybody else. So we kind of need a little bit of follow up here. We need this to resolve. The good thing is if you wait, you're not missing anything because there is a long ways to go, right? If the drop does come, it will be a big enough drop that waiting didn't cost you anything. There's plenty of room. But what waiting can do is stop you from getting caught in the rebound if this happens to flip back over and run back up again. So something to consider. Also, because of the holiday and everything else, if we were to kind of set ourselves back to Friday and ignore the fact that Monday was there at all, which is kind of what the daily chart here is doing, right? We go from the 17th to the 21st, and it's ignoring anything else, right? Like, what Monday? There was no Monday. And like I said, every broker struggles with this. It's an issue that just really doesn't have a good solution. Me personally, I ignore that Monday even existed at all. No RTH open or close. I don't mark either one of those. I don't really focus on its Globex levels, and I wrap it up into today's trading. Now, the candle of concern is this one. That is February 1. And that big dominant candle is the one that's in control. And all of this has been happening inside of this one candle. We need to definitively get outside of this candle. Now, a lot of places will say it needs to close below by the end of the day, right? Daily chart needs to close below. I'm not that strict. Usually by midday, maybe a little bit beyond midday, 1 o'clock or so, if we are clearly outside the box and price isn't working on getting back into the box, you're usually pretty good to go at that point. There's a quant tool here, the quadrant lines. When we're dealing with a range, that's a really great tool to use. Just measure the range. From the top of the candle to the bottom of the candle, which is the range that we're measuring, 50% of this measurement is 39.91, which is a level that we have visited so many times. And then 100% of this move is 39.33, which is really, really close to the 39.31 cog line that we would just say 39.31. Now, when it comes to measuring price like this, a head and shoulders, a flag, a rising wedge, whatever price that you're measuring, 50% is usually the first target, right? Target 1, target 2, target 3. So you want to be really concerned when we get to 50%, if we, get that breakout. because that could be all that it's going to give us. If we do get past that level, then we target the next level. So when you're looking to take your trade, don't use 100% of the move for your first target. All right, we are underneath the 3 on the ES, and we are a considerable distance away from the 3. So we're looking for a little bit of a pop up first. As much as you guys have heard me talk about the 10 and its relevance, a 3-period moving average is more of a surge rather than a trend. But just like with any other moving average, how far away from the 3 we get becomes important. Just like how far away from VWAP we get becomes important. So the EM is less this week, which makes sense because it was a 4-day week instead of a 3-day week, right? So, I mean, that kind of makes sense. If we take the box, this shows that the EM for this week is actually bigger than last week, but we'll get to the why here in a moment. This box that I have is the size of last week's expected move. The box here is this week's expected move. So it's 1 day shorter, but definitely much bigger. So why the discrepancy? Well, this indicator can't actually read what's on the options table, right? So it can't read in here. Thinkorswim doesn't allow us to code indicators that can get these numbers here on the side. So the creator of that indicator, the guy's name is Mobius, he did the best he could, right? Because this is like a square root formula, and it uses all of the out of the money options and the put side and the call side, and adds it all up and kind of averages it with a square root of time. It's some nerd stuff, right? So he did good, as good as he could, but you're better off hand drawing your lines. The thing is, that weekly expected move, you have to get it before Sunday night when we open back up again. You have to get it on the weekend, like Friday at 5. Anywhere between Friday at 5 to, say, Sunday morning, because even in Sunday afternoon before we open, the numbers will start to change. Thinkorswim offers a tool that you can use called Think Back. So we can actually go back to last Friday and see what the numbers were, which is cool. This is the close for the ES on the 17th. And we can look at next week's expected move this way. And then we can get the number and go out and hand draw it, right? And we can do all that. So even if you didn't get it on the weekend, you can always go back and get it. And even though that indicator isn't perfect, what it is good for is, imagine if you wanted to see Apple or Google or Tesla or whatever. That's a lot of markets to look at over the weekend, trying to get all of these numbers. So it's going to give you a nice approximation without having to go back into the think back and look at every single one of those that you didn't catch, right? But doing it by hand is most certainly more accurate than using that indicator, especially in volatility. So the other half of that question about the inside week. Well, here we are on a weekly chart, and you can see the range is much, much bigger. Now, an inside week or an inside day, or just an inside candle in general, when it's really small, like down here, the outcome is often fantastic. It's this big, explosive, like spring that just rips in that direction. Beautiful. But when the inside candle comes from this really big range, there's not a lot of anticipated follow through, because where's the compression? Now, if we get rid of the big green candle, and we focus on the red one, and use that for our inside week, well, that's certainly a lot shorter, right? And that fits the bill. That's some good compression. So now we've got the 2 weeks. But again, once we bring it out to the daily and look at it, that's not a whole lot of compression. We have a March FOMC coming up. It's quite a ways off. We still got US CPI, PPI, job numbers. There's a lot of data points coming out between now and then. And the market is still showing a lot of bullish bias and buying pressure under the surface. So, playing another inside week would be as simple as just putting on an iron condor, or legging into an iron, or building butterflies on the edges. That would certainly be cheaper. And, since it's options, we can play the range rather than playing, a directional move. The hard part about trying to use the iron, if you don't leg into it, is how wide this box is. So before COVID, before, the February 2020, we dropped from the highs, before all of that ever happened, what we used to do is we'd build our iron condors using the edges of these lines. But the lines were so much closer together. They were a lot closer to this middle point, which is at the money. And so we would have, a reasonably decent iron condor on the week, and we would risk 4 to make 1. It's not the greatest, right? But I mean, it is okay. Now, because the box is so big and those strikes are so far out, that you have to risk like 4.75 to make 25 cents. And that's just not going to work, right? It's completely inappropriate. So we can't use the lines for our iron condor. We can do a double diagonal. That works. I call it the Marcus trade. I've done videos on that. So we can do a double calendar, double diagonal. We could build butterflies on the edges. Or you can leg into that iron condor by first opening the lower, the put side. And then if, we hit the edge, we bounce back up. We get near the high. You can open the other one up there. And if you're thinking, what, hit both sides in the same week? Yeah, just like we did here. We hit the low end, and then we hit the high end, and then we still closed on the week inside the box. that would have been a great week to leg into your iron condor and have a free iron condor, a condor with absolutely no risk. It really feels like there's a lot of shenanigans going on. I like that word. It seems to fit. And while we can play the range, I'm really not interested in it. I want to leave the range. So for me, on a day-to-day, I'm willing to play the range, but for the bigger picture, I don't want to play the range. I want to leave the range and I want to get a trade on. So that's kind of my focus, that we have other things that we can play, right? Gold's still doing really good to the downside, that playing out nice. We've got, bonds, the week TLT, TNX. You got some energy plays that are doing good, right? We still have things that we can do other than trying to force this. All right, the KWEB constituents are down this morning, which is kind of important. You definitely want to keep your eye on that one. There it is. I was going to say, I'm missing it. Also, emerging markets is down. Let's see how Asia closed. Got a bear sandwich. And for London, we've pulled up off of those lows like we have been doing recently, right? Those buyers keep stepping in to defend the lows, but we're still down on the day. So we're weak in Europe, weak but recovering or pulling back off. And in Asia, definitely closed on the lows. So if we kind of game this out, right? Asia went down and Europe went down and the S&P went down and, the American markets, all the markets went down in the overnight. And since Asia closed, it didn't rebound back up. But, it's 1 o'clock in Europe. They've already started to pull back up off of those lows. So we're definitely not getting, like a nice follow through boost this morning from, say, a good Asian market bleeding into a good European market that bled over into a good US market. We're not getting one of those days today. And the Dow really took a gut punch yesterday. It was interesting. The scope and the pace of it certainly got my attention. All right, so WTI is still within this range, although, we were getting some higher lows and higher highs, in that wave. But that's over because we set a lower low back on the 6th, and then we set that lower high. So again, ranged markets, not just in the indexes, but all over the place. And I said earlier in the year, the first week, second week of January, 2023 is supposed to be the year of the range, where it's just going to be a lot of back and forth and sideways and fights and struggle. At least that's the projections. And so far, it's proving out well. whether we like it or not. All right, so I'm going to stress caution that yes, we're down, but it's mildly down, and that we could recover and rally through the day today. And so don't get too heavily bared up. Meta had news, right? They're going to look at going into a paid subscription service on Meta. And of course, that means money. So their stock is up this morning. Walmart is down. A tangent company, not Tesla, but a company connected with Tesla, had like a 28% move this morning. SGML, excuse me, I said 28. It was 26, a 26% move. That's wild. JD, this is a representation of the China names, down 8%. That very likely has a lot to do with what we're seeing in the other China ADR names. All right, so let's put some numbers behind it. 36% of the NASDAQ is down more than 1% this morning. That's a pretty solid bearish number. Like it's not scary kind of bearish, right? They're just not selling willy-nilly, but that's a solid bearish number. For a 0.5%, 50% of the NASDAQ is down at least 0.5% this morning. And again, that's a good solid bearish number. For those names that are down 1% or more, JD leads the way. But when we're looking at JD, we want to add in its other constituents, those other China ADR names, like PDD, Baba, Baidu, and I'm not seeing those. What I am seeing is a lot of monsters of tech. Those FANG names, NVIDIA. Oh, there's PDD. It slipped past me. NVIDIA, Google, Tesla, and Apple, Netflix, and PayPal, Amazon. They're all, almost all of them are on here this morning. So the FANG names are down. They used to be, and a lot of times they still are, they used to be big enough to control the market. So you could have 80% of the S&P going down, but as long as you had the FANG names going up, we weren't going to go down. Their notional value is, I mean, just, all around things have changed. If you want to keep track of those names through the day, you can use that NY FANG. It's like an ETF or an index. It's more like an index really than an ETF because there's no volume to it. I don't know how they replaced Twitter, right? Once Twitter went private, it was in this, and now it's not. I haven't gone to check to see, if they replaced Twitter with a different name or if they just are running with one less name now. I honestly don't know, but it's worth checking out. But this is a good representation of those FANG names on a day-to-day basis. Compare that to how finance moves, right? Because the NASDAQ 100 doesn't have the financials, the S&P does. So, at first, are we divergent between these two, between tech and finance, or are they working together? If they're working together, we're going to move in that direction in the market, up or down. If they're divergent, then we have to see who's running the show. Are financials overtaking, or are the FANGs overtaking? Lately, I've seen a lot more of tech versus finance and not tech and finance. So they've been working against each other more often than working together. %47 of the S&P is down 0.5% this morning. Target, very, very likely in sympathy with Walmart. A lot of chip names, AMD, Qualcomm. Microsoft, Google, the FANGs, of course, Oracle. Pharmaceuticals are down this morning too. I was just about to say we could probably focus on some capital rotation, healthcare, utilities, staples, because I'm not really seeing a lot of those names. And yet, I mean, if Nike and Starbucks, and so let's look at what is up this morning. Shouldn't be much of a list, huh? Meta, yeah, that didn't get us very far. So what we're looking at here is the S&P 500 with a filter applied to knock it down to very close to 100 names. I filtered them by market cap. So it's kind of my own little bastard version of the S&P 100 because they don't let me pick S&P 100 from a list. So this is as close as we could get to that. Raytheon, Chevron, Meta. There are a few individual names that are doing, reasonably well this morning. But for the most part, we're either flat or negative, but we're not drastically negative, not yet. Now, I just want to keep coming back to say that again and again. Don't bear up and get heavy negative bearish yet. For the NASDAQ 100, we don't need a filter because there's already 100 names. Just adjust the multiplier. Nothing, right? AstraZeneca and Meta is it. Everything else, shiny bright red. So there's not a capital rotation yet. And there's not a particular sector or industry that we'd want to hone in on yet. So right now we're on a weekly chart. If we were just to snap a line, we have broken that trend line. But it's after a holiday, and Monday don't count. And we could very easily take this back. All right, so that's kind of the one we really want to focus on. Below 4,000, 38.5 is going to be the target, right? It's going to be down here, the low of this range. All right, UNG has set some new lows, right? It's gone lower than I think any of us really expected. That is all the way back to 2008, and we've never seen it as low as this. Again, a really good double bottom. We'll peak through the previous bottom and then rally back up. Just like back here when we had a double bottom, we went lower than the previous low, and then we had a follow through. Now we're just dealing with a bigger double bottom. We've gone lower than the previous low. Everybody's watching this for a play, right? And they want to run it by themselves. They don't want to share it with you. So if they can get everybody to dump their positions and then run it, they need the liquidity. You would be providing that. On the other hand, this is also a seasonal thing, right? Weather matters. So there's a lot of factors to go into nat gas. Either way you play it and either way you approach it, that sucker is down. It is weak. And looking at it on a daily, it's a gap down on the 17th. We need to see what it's going to look like this morning. 776 is where we closed on Friday. And 756, just using some creative license, is where we're at this morning, having gapped down another 20 cents in the pre-market. Watch the low of yesterday, or basically Friday, for our rebound play. Because if this becomes an island reversal, what it'll do is gap down, build an island down here, and then gap back up again. In the book, Hit and Run Trading, they have one called a Gilligan's Island. I don't know. The name's just... If you look in that book, though, they do lay out all the structure for all the criteria for trading an island reversal. Nat gas shouldn't follow USO. You know, I've been listening to a lot of analysts going over nat gas too, and every one of them said, I got nothing. And I didn't feel so bad, right? I was like, you guys have been doing this for 40 years. And if you say I got nothing and I ain't got anything, then I don't feel too bad. So, you know, we're all waiting on this, trying to figure out what we want to do with it. I took the old tasty trade approach and I went long because it was at its lows and it had made a really big move really fast to the downside. I just kept my position small. So I'm willing to scale up once it proves that it's actually going to come up off of these lows. The most consensus right now says that we're very likely going to chop around and build a base down here for, a good month or two. The size of that base is kind of where the big argument comes in. Is it going to be a small base where we stay underneath 9.5, or is it going to be a bigger base where we chop, say, between 15 and this low here? And it could last for 2 or 3 years. This is a really great example of what Wyckoff talks about, right? And just kind of start digging into the old Wyckoff books. Classic accumulation, distribution, blah, blah, blah. If this was a company, I'd be worried about like bankruptcy and all kinds of stuff like that, but it's not, right? So yeah, at least we don't have to worry about that. Really keep your eye on those KWeb constituents, right? All those China ADR names. Because if they start to turn around, it's going to be another representation of that risk on sentiment, that buying pressure that we continue to see coming into the market. Another proxy that you can use for that risk on sentiment would be Bitcoin. And as long as the rally continues in Bitcoin, you're going to continue to see that risk-taking, risk-on sentiment, right? And I don't mess around with individual coins. But now that we have Bitcoin ETFs, we can trade both directions, up and down. And that's what makes it tradable, right? Not the coins where you can only buy to get in and sell to get out. I want to be able to short things, make it a two-sided market. But as long as this continues to stay strong and pushes to the upside, expect that overall market buying pressure to still dominate, right? And that's what's really screwing everything up. A ton of analysts right now have a million reasons why we should be going down, or why at the very least we shouldn't continue to go up. And yet the buying pressure is trumps all of that. All right, should be getting some data in. It's 8:30. Got a TRB set up with a little bit of buying flow. Back to VWAP. And then 4070 if the push continues. Everybody be careful, be safe, keep your eye on the prize. And just remember, if we're going to break down, there's plenty of room, right? There's no reason to jump in early. You don't have to. You can let this really start to prove. Otherwise, if we rebound again, then we're just going to target the top of the range. And keep in mind, people are going to front run, right? They're not going to run it all the way back up to the top, because nobody wants to be the last one holding the bag. So they'll start getting out early. And in a bear market and all this violence and volatility, price overshoots pivot points constantly. So if your pivot point is 4060, you could expect an overshoot, right? And I will see you all tomorrow. Watch the clock.